Presidential Wealth Management. In the next hour, learn how to find and evaluate investment opportunities in a down market, why it's a good idea to have a financial plan, and why it may not be a good idea to work with two or more advisors.
Here are 5 things to think about. Historically, on average, stocks have fallen 36% in bear markets, and they've risen 110% in bull markets. On average, bear markets last for 10 months. Bull markets last for 2 years and 9 months. After hitting bear market lows in March of 2020, the major averages rallied well over 30% in just 1 month. The Fed says it will keep its interest rates near zero until the U.S. economy reaches full employment. And number 5, COVID-19 could forever change the way we work. Now, to experienced investors, every single one of these things are signs of investment opportunities. And that's what we're going to talk about this week. Also, this week, we are joined by Alexis Herman. Alexis is a senior advisor with our firm with a passion for helping you achieve your goals and your financial freedom. Alexis, thank you for being with us.
Thank you for having me today, guys. It's great to see you.
I'm Keith Weinman, along with Taylor Leary at Presidential Wealth Management.
Keith, thank you so much. And those are some very interesting facts. We are certainly faced in interesting times right now. So this is, something like the 7th week home, and we're navigating with the world that we're faced with. But before we dive into all of the great details and the information that we're going to hear from Alexis and Keith and myself, I want to talk about a couple of housekeeping items so you can kind of help interact and kind of make the most of today's webinar. So you'll notice that over on the bar over here, you'll see some different tabs. The first I want to bring to your attention is the chat box. So the chat box is a great way to ask us questions directly. For today's event, I've kept that chat box open to the public as well as the private. So what that means is that you can ask a public question, so you could put that out to the audience. We will also see that so we can interact as well. Or if you feel like it's a little personal in nature, or maybe you just feel a little sheepish about asking that question, you could certainly send it as a private message where only the 3 of us hosts will be able to see that. So we invite you to ask questions. We know that these are some trying and uncertain times. So ask the questions that are on the top of your mind. And we hope with the information that we present today, it'll maybe elicit a few more questions, and we might be able to provide some clear answers for you. Also want to introduce polls. So throughout today's webinar and presentation, I have several different polls that I want to hear from you. It's always interesting to see what's going on in the market and also the psyche of the investors out there. So use the polls as a way to interact. I will prompt you to do that. Right now there are no polls, but I will be sure to let you know when we're asking a poll, and we would love to hear your feedback. Now, we're only limited in the amount of questions or answers that we can provide, but have fun with it. And if you want to maybe add an additional answer to one of the polls, use the chat box feature to throw in a curveball at us. And then finally, I want to just discuss quickly how to connect. There will be a way to connect with us here at the end. I'll provide an email. I will provide our contact link, and then also provide an offer that you can click to sign up for a portfolio stress test. But we'll get to more of those details later.
In the past few weeks, we've all lived through something that really has never happened before. The pandemic and the economic shutdown have forced changes in our lives, our businesses, and our finances. Some good, some not so good, and many of them remain to be seen. But from an investment point of view, change always creates opportunity. So let's talk about how to find and evaluate opportunities. Let's talk about how to decide whether those opportunities may be right for you or may not be right for you. And let's talk about how to put them in place.
So I talked about how to connect. And one of the ways to connect is through a portfolio stress test. So if you'll notice on the bar here, there's an offer. And in that offer is a way to connect with us on a portfolio stress test. Who might this be for? This might be for the DIYer that wants to know what a better direction is forward. It also might be the person that already has a financial advisor and they don't know exactly what they don't know. We talked a lot last week about questions that a lot of our clients are facing or asking us, and we want to open that to you. So a portfolio stress test is a second set of eyes. It's looking under the hood and seeing what are you actually invested in and what's the plan going forward. Do you have losses? Are there things that may be snakes in the grass that you don't know that are there? So a portfolio stress test is an opportunity for you to strip it down, see what it's all about, and get a view from one of our advisors to identify maybe some blind spots and then also some opportunities forward. Today is all about talking about changes, looking at changes, and then what are some of the guidelines that we need to follow or maybe that you should consider following, and then what are the real opportunities that exist out there. So I'm going to open it up right now, and I'm going to do my first poll of the day. All right, so we started this poll way back when we first started this event, and it is, where does the market go from here? Does it go up to pre-pandemic levels? Does it go down to kind of test previous levels? We saw the bottom of the market so far on March 23rd. Or does it just stay flat with continued volatility? Now, we don't exactly have a time frame on this, but maybe let's just say over the next 6 to 8 months. Let's use that as our time frame. Where do you think the market goes from here? We've seen a little bit of a bounce back. Alexis, provide a little insight in your world. What are you seeing in the market right now? And maybe you can provide a little color to our audience here.
Sure. And thanks, Taylor. It's, again, great to see you guys. So based on reports from yesterday, I think it's timely to go ahead and share this with the audience as well. Our estimated GDP reports that came out yesterday does show a contract of about 4.8% through the first quarter. Now, we know in moving forward that those numbers are not going to be finalized until, probably a month or two from now. We do anticipate that that's going to end up being a little bit higher than what those original estimates are coming in at. But also, as we're looking forward, we also need to be talking about Q2, Q3. What are some predictive mechanisms there? And estimates is that we're really going to see a further contraction, and we should be anticipating this of about 25% or more. And Q3 showing a more modest decline from there. Our greatest weaknesses were in consumption, and the weakness in the services really amplified those declines. And that's kind of what we're seeing. Will it drop to March levels? The answer is, we don't know, right? So what it comes down to, and I think the more important question to ask is, what does turning the economy back on look like? And there's this great analogy that I actually wanted to share with you guys because I thought it was very perfect really for this time frame. And when we look at our economy right now, we really turned it off like a light switch. So just to give that absolute visual, literally turned it off. And moving forward, as we're turning the economy back on, that is going to be done with a dimmer, right? It's not going to be that flick of the light switch and everything is back to exactly where it was. But as we're looking forward from a very positive standpoint, we are looking at what are the opportunities that have been created right now for our investors, for our clients. What are their long terms? What goals have changed. What does that look like inside of their portfolio, and what needs to be addressed as we're moving forward? Until we have, probably a vaccine that's widely available and distributable, that's where our risks lie at this current moment in time. But we also know that our right now today, with my 2 kids doing schoolwork in online classes downstairs, myself, and all of us in our at-home offices, that's not going to be where we're at a year or 2 years from now. That picture is going to change.
Yeah, that's something that I've been talking to a number of clients about is that the first reaction seemed to have been a reaction to the virus. So COVID-19, whatever you want to call it. And then the second reaction, which we haven't seen yet, market's up like 26, 27% from its March lows. And so that first one felt like a reaction to the uncertainty and the fear that was in the market. But maybe there's a wave, the second wave, that might still be there, and it's more of the economic wave. Keith, any insights and thoughts there?
One that comes to mind is economists will tell you almost unanimously that it is not the depth of the economic contraction that weighs on the economy, it's the length of the economic contraction. It could drop, as Alexis says, 25%, it could drop 35%. Come back quickly, the damage wouldn't be as bad as it would be if we had no recovery in this year. If we remained in negative growth or zero economic growth for a long time in, say, the first half or even second half of next year. Far more damaging to the economy than it would be if we go down deep and have a relatively quick recovery. Has everybody given up on the V recovery?
That's a good poll question. I know. I think we should incorporate that, Taylor.
Well, it's funny that you're talking about staying at home with your family where the kids are downstairs. I can currently hear a dog, a little 24-pound French bulldog, pawing at my door trying to get in. So we all have our own distractions. I just happen to be at home with a 7-week-old and my wife on maternity leave. So feeling very fortunate about that. So let's just dive right into it. Alexis, one of the reasons that we had you on or really wanted to have you on is that you just have such deep relationships with your clients. And we know that a lot of the conversations that you have are really telling because of those deep relationships. And we wanted to share that with you, the audience, to say, what do you have, what's going on in real life circumstances. So I'm going to start off with this visual here, and then we'll get started. So what's the first situation that you've been seeing with a lot of your clients? And tell me about kind of the bigger picture here.
I absolutely love that slide. So put me in, coach, meaning that at this point in time, there's cash that's sitting on the sidelines. And this can look in a couple of different measures, and I'm going to talk to you about a more specific client case because I know that a lot of people can probably relate. So the first one that I want to mention is that there are individuals that are out there, some of them that may be on this webinar today, that they sold their portfolio positions and they went to cash. And the questions that arise from that is, when is it going to be appropriate to time frame wise get back into the market? And with that, what the heck should I be buying? So I'm going to take it from that standpoint, but the other standpoint too, from this specific client case that I wanted to talk about today, was we had developed a very large cash position on the side for a very specific shorter term goal that him and his wife had, and their goals have changed. So we had a conversation that cash was not going to be deployed in the manner that it was originally planned for inside their plan. So the conversations had to shift of, do we keep that cash sitting on the sidelines? And the answer to that is no. And what is appropriate? What works inside of their specific plan? Now, this couple is several years out from retirement. We do have a very, in terms of their plan, we have an absolute baseline in terms of what the income needs and goals and those pieces are going to be in retirement and leading up to that. So this specific cash piece, more so for them, is to create a little bit more of an alpha and take some advantage of some opportunities that have presented in this specific market. What we're really looking at, and what I find that I'm having multiple conversations around, so this is why I wanted to share this with you guys today, is what are the opportunities in the equity piece right now? Are there opportunities in the equity side of the market? With knowing that this volatility is most likely going to keep going. And the answer is yes. We're finally seeing actually sectors and industries that I feel very honestly were overpriced for longer periods of time, that have priced into ranges where it could be very, very beneficial to incorporate them inside the portfolio. Specific sectors, I'm not going to give specific companies, but communication services is a great one. There is going to be some changes after the pandemic, and there is some envisioning where our company is going to actually have employees continue to work from home, and the potential is there. Consumer discretionary, healthcare, industrials. But the focus around that needs to be very specifically, and this is what the conversations that we have with our clients is quality. We're talking about balance sheets. What can companies withstand? Looking at forward PE ratios. And the reasoning behind that is, yes, we want to get growth out of these assets, but it also needs to make sense inside of their plan. What I challenge clients with continually in the conversations that need to be continually had and people need to be looking at in their own circumstances is, what is your emergency fund position at this point in time? What is really the excess cash that you have on hand? What can you do to strengthen your specific portfolio and have it play a piece into your long-term plan, but still accomplish your short and long-term goals?
So what kind of questions are, like maybe a question that I have is how do you get back in the market? I mean, is it like, do you take the whole chunk and then chunk it right back in, or like wait for opportunity? Like how do we get back into the market now?
Well, honestly, that's going to depend a little bit on the client. I will say that at this particular moment, I was, for the cash that we do have on the side right now, we were actually waiting for some Q1 reporting to come in and looking for the forward looking. But I'm envisioning that specific client that I actually just mentioned to you. I'm actually envisioning probably within 2 to 3 weeks, we'll have all of that money deployed. We're not going to market time it from a perspective of looking to buy at the absolute lowest. People love that theory. They love that concept. It's next to impossible to do. So quality, what is it going to do inside of your plan? And going back to what you talked about, Taylor, which is so incredibly important with all of our clients, is the risk that they're taking inside of their portfolio appropriate for their stage of life? How many years do they have until retirement? What needs to be protected? What needs to be focused towards growth to offset inflation? Those are really overarching questions that need to be really understood in order to build a functioning plan.
So typically when you're working with clients, what are some of the guidelines? We talk and we preach about patience and sticking to the plan, but what are some guidelines that you're talking to your clients about right now to navigate when they want to get back in and do some of these opportunities? Is that going against the grain as far as what they were already doing? Provide, like, what guardrails are in place for you?
So there's a lot of guardrails that are in place. And again, it just has to do with both the short and the long-term goals. So from a perspective of looking at it, again, the market timing is never ideal. My clients that we do have agreements in place in regards to, I do want to get in if, when the S&P triggers this number, and I'm okay with that. That's totally fine. Is that a version of market timing? It is, but it's a much more simplified and much more manageable version of market timing. Again, for me, it's about, this is where we're buying this specific company. If we're staying in the equity world, this is where we're buying this at. This is where it's been. This is where it has the potential to go. But does the risk align with what you can handle inside your portfolio for this piece of money?
Some very, very valid points from Alexis. And I think you mentioned the choices that you have. Just reinforce with yourself and remember that you have the choice of buying, selling, or doing nothing. Always those three choices: buying, selling, or doing nothing. Now, there are variations. You can buy more, you can sell some. Doing nothing, that's kind of there. But doing nothing means you've got something that is good long term. And as Alexis said, I think you mentioned cash. You mentioned strong balance sheet. I would also throw into that, does a company have both a virtual and a physical presence as we move into the future? Think about the changes we're all going to go through on so many different levels. Well, companies are going to go through those changes on even more levels. And so keep those things in mind for long-term holdings. Cash to make it through this tumultuous period. Balance sheet, that's just common sense, and a virtual and physical presence to continue to do well in the future. Another point, Alexis, that you mentioned that I so much appreciate is keep cash. Don't go all in at once. Never try and time the market. Keep cash for so many reasons. Realize if you found something good, we could go back down, and that will develop more opportunities. Keep some cash for that. And so many valid points. And it all goes to an interesting point. It all goes to your relationship with the client. And I always go back to the things that I believe in so strongly, to which the client, to which you viewing might say, well, how do I find that relationship? And my first sign of an advisor that wants to get to know you like Alexis wants to know her clients is to find somebody that listens more than they talk. If they talk more than they listen, they've got their own goals that they might be trying to put in place with your business. If they listen more than they talk, I firmly believe they're going to be more like Alexis. They genuinely want to know you, their client, and have that relationship to move forward in the future.
Yeah. And I will say, we're all fiduciaries for our clients' accounts. And the biggest thing that comes with that is that, and I always tell clients this up front, we have the capability to build a retirement plan for anyone. It doesn't matter who that person is. But unless we really understand who they are and what they want to accomplish and what they need or desire in the short term in terms of their goals and in the long term, it's not functional. And if a retirement plan isn't functional, it's almost like it's like a moot point as far as I'm concerned. So those relationships are so beyond important, because that's how clients accomplish their goals.
Yes. And that goes to something you said a couple of weeks ago right here on the program. You're 35 years old, and Taylor said, yeah, I've retired hundreds of times. Well, he's gone through the process with hundreds of clients. That's experience that is so valuable. I had one client one time after we had put together a plan and he had gained some confidence in where he was going in his future retirement years. He just said, wow, I never realized that all this was so important. He says, I've never retired before. Well, that's why it's a good idea to find an advisor like Taylor, who's retired hundreds of times.
Well, thank you, Keith. That I appreciate you bringing up some stuff we said the other, and also reminding me, that I've got some years to gain on you, man, with some of the skills and experience that you have. But that really is some great insight, and it sounds like this is a lot. It's springtime right now, so I'm going to use a little bit of a spring analogy here, and that is it's springtime, and this market is really challenging. And just like when we go out and do our summer or spring, fire up the sprinklers and get the lawn going, we don't just take the fertilizer and dump it in one spot. We spread it around the yard evenly, because if we put it in one spot, we run the risk of maybe burning the yard and kind of getting burned here. And so spreading that fertilizer across the yard, spreading the cash across the markets to not just dive in one spot. That it's something that it's more like farming rather than just going out and hunting and killing. And that's at the end of the day what we need to be focused on. And so, Alexis, that is a great experience, because we've all been dealing with clients that have cash, and I mean that in the best possible way, but that's just the reality. So let's shift gears a little bit and just look at what happens if you've got losses. So maybe somebody is looking at their portfolio and saying, gosh, maybe this is a good time to reposition. Maybe you had some exposures. Maybe there isn't necessarily cash on the sidelines, but there's some levers that you can pull that might provide a little bit more of a benefit. So how do you reposition under pressure? Because right now it's kind of a pressure-filled environment. And so my question to you is what are you seeing out there with your clients, and how are you repositioning in today's market?
Absolutely. And I'll take it from a case study. Actually, I'll share with you a client very recently that we did completely reposition their portfolio. And one of the main reasons that we ended up doing that, and why this conversation came about, is that a lot of their retirement income, they are current retirees right now, but a lot of their retirement income that they were receiving on a monthly basis is from residential real estate properties that they own. So one of the concerns when we were going through and talking about these impacts and moving forward in COVID and what that may look like is that they have concerns, and very good concerns, that their renters are not going to be able to pay them potentially full rent for a period of time. Or there was one property in particular that they were very concerned that they weren't going to get any rent off of for a period of time. It's not that they're looking to go and try to evict tenants, and they're working with them in every way that they can through this market. But that particular portfolio, we needed to take into account that we were going to have higher cash needs. And there's a potential for that to continue for a slightly longer period of time. We don't know exactly what that length is going to be. So in repositioning their assets, it was a combination approach, and it was creating quite a bit more liquidity that could cover that rental income stream. And that's something that we're actually communicating with each other on a month-to-month basis of how much that they need to withdraw from that specific account. And then also, again, just from very high quality piece, and also from a protective mechanism, we did implement some additional dividend producing, but some very, very ultra short duration bonds inside their portfolio through some amazing managers that we have on our platform, and as well as some additional money market as well, but at least it was making something. But so the concept is that there has to be a fluidity, and we need to understand if there are higher income needs, especially. That's one of the things that we do on a constant basis, especially for our current retirees. They're depending on this income off of their portfolio or whatever investment streams that they have put together. And we need to make sure that that's meeting what those needs are, especially when things are thrown in that may change that for a very immediate time frame.
Don't
Sorry.
fall your investments, even if they're rental homes. Never make investment decisions based on emotion, even if they're rental homes. And so then you go back to the question. I'm fascinated by that situation you faced with the person that wasn't going to get any income. If you boil it, if you separate business from personal, if you separate a business decision from an emotional decision, wouldn't you say, okay, the markets have come down. There are opportunities to get, for example, dividend paying stocks that are going to pay me a pretty good return moving forward because they're going to cost me less. Take out the fact that one is a rental home that, we've owned for so many years and it's been so good to us. Just look at them as two investments.
Correct.
And as far as then the other question that comes into play with that, Alexis, is should I sell and take losses now? Does that go against, or does that play along with buy low, sell high? Because don't forget, if you factor out the emotion and you simply evaluate the two investments, evaluate them with regard to their long-term potential, their income, what's going to happen over the short term, and forget the fact that one is a rental home and one might be a dividend paying stock or whatever, and just say which one is going to be the best moving forward from this point in time.
Those are great questions, Keith. Yeah. And what I will tell you is I know that you guys have experienced the same thing where you have clients that come to you and they're maybe overly invested or very heavily invested, or really the only assets that they have are in the real estate world. Now, what I will say is that I personally love real estate as a diversifier inside of a portfolio. I have a couple of rental properties as well. So it is, but it can't be the whole kit and caboodle. So as I like to talk about it with people, we do have to have diversification inside the portfolio. And although this is an extreme example, I think it is a really good example. There was multiple questions that you asked there, so I'm going to try to address them one by one. Should I sell now and wait? Should I sell now and buy back in? So is there an absolute succinct answer to that? The question is, it depends on what you own, right?
Yes.
So first point I'm going to make to that.
Let me just jump in and let's ask our audience. And before we go, so I have a poll question here for you all, and that is, what if you have losses in your portfolio? Many people, especially their growth portfolio that are exposed to the market, have losses, or at least have come down from highs. And so what do you do if you have losses in your portfolio? Do you A, do nothing and ride it out? B, sell and go to cash? C, sell and create a plan to buy back in? Or just don't open your statements? Now, Alexis, I'll let you run with it. I'd love to hear from you all, our audience, on what you think the best move forward is.
So one of the conversations, or a number of conversations that I've been having with my clients is we have actually started doing a lot of tax loss harvesting inside the accounts. So the concept behind that is that if we are seeing losses in some of the investments, depending on what the positioning is, and again, I'm not going to talk about very specific stocks, but depending on what the positioning is, it's really taking a look at, did that investment perform as you expected it to during this market? If it didn't, which I think a lot of people were surprised by some things. At least that's what I've heard from new clients that have come in more recently, is that they were very surprised at how specific investments reacted, that we have repositioned at this point. So tax loss harvesting is going to be a big one. This is going to be outside of retirement accounts. Does it make sense to sell some of those positions and actually garner or take that loss? And there is a strong potential that it does if there's another position to replace it with, that we can buy at a discount at this point in time, that we really do believe is going to have a stronger ability to do well in this current market, but also in moving forward when we get to the American recovery, as I like to call it. That's my new nickname. I hope you guys don't mind me throwing that out there. So again, repositioning is incredibly important, but we have to be very diligent in how it's done. What portfolio, what section or piece of the portfolio needs to be in a very safe place. That has to do with the cash that's actually kept aside. That has to do with the emergency fund. That has to do with, potentially some other products, potentially. What does need to be put into more of a growth module, and what do you have? What do you own in there? What did it do during this market cycle? And were you able to manage that? I am never going to tell a client not to open their statements. They should open their statements. If it gives them unrest, they pick up the phone and call. But I know for a fact that all of my retirees, they open their statements and they were like, oh, okay, great. So that's, it's the positioning of the portfolio is so incredibly important, but people do need to look at tax loss harvesting. I would suggest at this point in time.
I hit on a number of things there that I want to go heavy on, but I'll do my best to kind of keep it at bay. And so for you kind of listening here today, there's a couple of things that just kind of jump out is if you make a change, make it with a plan of action going forward. And then number two, something that just blew my mind, which I've been talking to a lot of clients about as well, and I'm just glad to hear that you're kind of in the same headspace, is did the asset class or did the investment perform as you would expect? So a highly risky investment that was down 30, 35, 40% in March, that wouldn't have shocked me. But what did shock me is what happened to the bond market, but we've seen since come back. And so we don't need to necessarily make these irrational or rash decisions that we just shoot from the hip, but rather making it with diligence and then understanding that expectation of what you would expect from how something performs.
Absolutely. I couldn't agree with you more. And I do find it very interesting. Did you guys see the poll answers that came back in?
Yeah.
So 85% said, do nothing and ride it out. Right. So I'm going to assume that those are the people that, they're very comfortable with potentially what the underlying positioning is that they own, and they're okay with that movement. I am going to really strongly suggest one of the things that is really important is, does it make sense to tax loss harvest out, to sell and create a plan to buy back in? But yes, Taylor, you hit it right on the head from a perspective of we need to know what we're selling, why we're selling it, and then what we're going to buy. And there has to be a reason for it in looking forward.
One reason, look at a portfolio and going through this that we've really never been through before, is realizing that this that we've never been through before is probably going to happen again. In various iterations with the various changes. We usually have bear markets at least every 3 years. Was it 2 years and 9 months? And so with that in mind, take a look. What's happened here gives you the opportunity to look at that statement and look at and see what's been hurt the most. Do you want to hold that looking forward compared to other opportunities that you may have? And that's something you and an advisor should spend some time on.
Absolutely. I think it's so incredibly important. And I'll take Taylor's, what he states on that. It's looking under the hood. Is it an ideal time to really look at, does the current positioning make sense? And in the majority of cases, what I've been so pleased with is from the managers and the who we use, who we have access to at this point in time. I've been really, really pleased with how they've done their repositioning inside of their portfolios and those continuous conversations that I'm having with them. From the bond side of, really increasing credit quality while still being able to maintain the dividends. I'm talking with a lot of clients about those dividend portfolios. That's how we're maintaining and doing our dollar cost averaging as we're moving forward. So I love it when my clients that I was speaking with at the end of March, and they were like, oh my gosh, Alexis, I just bought all of these shares so incredibly cheap. And I'm like, you did with your dividends. So, but it does help us in our compounding interest in moving forward. So I really do think, looking under the hood, it's such an opportune time to really do it.
Yeah, I love that. So the big takeaway for repositioning, it sounds like, is number one, understand what's happened to your portfolio, and then also how does that affect your financial plan. Right. Maybe repositioning doesn't make sense at all, but then also evaluate the risk of that change. You don't want to necessarily go from a bond portfolio that was creating solid income to going full board with like a stock that you're like, this is beaten up and going nuts. And so evaluate what that change really means to the long haul. There are things that you can look at making change. I always consider like using a scalpel instead of the butcher knife or even the chainsaw to make those changes. Consider that over just being like, let's throw the baby out with the bathwater and start over again. Make incremental changes, but then I'll also point to this. Don't be afraid of making change. This is something I always see this, and I saw this in 2009, is it took a little while, but there was a lot of new clients that I got during that period of time, and it was because the lack of communication between them and their advisor, and they just didn't have the confidence in the plan going forward because maybe there was no changes that were even recommended, or that they just felt like maybe there's I don't know, and they held on and held on and held on, and they were afraid of that change, so that status quo bias kind of gripped them. So my point is that we are here to help. We are here to be that backstop, or at least that second set of eyes to provide insights on what we're seeing with your portfolio and whether or not we believe that you're well positioned in today's market. So take this time to connect with us. Use the offer page where you can connect online with us, and you can just submit that. That'll come to us directly, and we'll schedule that one-to-one phone call. It's COVID friendly, so it's either a phone call or a video conference, whatever makes the most sense to you. So let's just move on to the last bit here. And I love this one because there's so much going on right now. There's just so much chaos going on. And before we really dig into this, I'm going to open up the poll question, the final poll question that we have, and then I'll turn it over to you. The poll question that we have is, what do you think the economic recovery, this is not the market, this is the economy. So what do you think the economic recovery will look like? Will it be a V shape where the economy rebounds quickly from this temporary shock? Will it be more of a U shaped where the economy takes a little bit longer to bounce back? Or this new prevailing wisdom is a W shape where the economy initially responds well, but then will fall again shortly thereafter. So more of that W shape, if you will. So with that, there's so much chaos. There's just so much going on in the market. Take some time to answer the poll question, but tell me about the chaos and how you're orchestrating the chaos in your client's world, Alexis.
Again, doing another case study or another client example. This is a new client that was referred to me. And when we talk about, or when I'm thinking of orchestrating the chaos, one of the things that I was looking at with this client, why it's such a perfect example, is when they first came to me, he had 2 prior 401ks from prior plans, workplaces. She had a prior 401k as well. There was some inherited assets. So there was a combination of different accounts that were, invested in different companies and things of that nature. The orchestration for me is so incredibly important, because one of the things that people, I feel like a lot of times don't do is they don't keep track of the assets that they've developed at different points in time, be it 10, 15, 20, 25 years ago, whatever that time frame is. And then it's almost like, so they get that statement or whatever, and they're like, oh, it's, like a little bonus, the money that I forgot I had. And for me, we should never, ever leave money in places where we don't know what it's doing or what it's doing for us. My biggest rule with all of my clients is that money has to be working. It has to be working. And it has to be working in the best interest of the client. So what I mean by that, and I go back, I know it sounds like I'm just beating a dead drum right now, but it goes back to the short and the long-term goals. Now, this particular client, this new client, we are looking at buying a car in next year. So conceptually, we have money that's put away or put aside specifically for that purpose, because that is what it's going to be used for. Emergency fund is fully funded. Budget is completely known, and retirement age and goals of that time frame are known as well. What I was able to do through orchestrating and coordinating all of those assets was to enable them to understand what, number one, their money was doing for them, to see how these different buckets are structured, because we had to put a protective mechanism on, because one of the two is the sole provider, and in terms of income at this point in time. And creating a portfolio that they could physically see how that was going to last them throughout their retirement years. The other piece that was brought into that specific portfolio, and it was done through specific investments, was a legacy piece that they were very determined for their son. And that was a baseline. What was kind of amazing is when these assets were passed to him from his father, it really made him think that this is something that I want to do for my son as well. And it wasn't necessarily a specific dollar amount. It was more so, it is amazing, the concept of having this financial legacy, that, and what it's done for us at this point in time as well.
Alexa, I can't but go back to the orchestra that began this segment.
Yeah.
You and the client wrote the sheet music. All of the musicians in the orchestra are all of the investments in the client's portfolio.
Mm-hmm.
And all of the investments in the client's portfolio are playing off the same sheet music.
Correct.
And the song is the client's retirement years, the client's quality of life, the growth that the client wants, the legacy you mentioned, what the client wants to pass along to their family. It's a wonderful analogy. And I think that the most important thing to be taken from it is the sheet music. The sheet music is the plan to create the music. And the music is the client's quality of life for the rest of their life.
Right.
I apologize for that, but that's
no. I so appreciate it, Keith, because it's you couldn't have hit the nail more directly on the head. It's I think that, and I'm sure you guys have heard this question before as well. So I've had over the years a few different clients that have actually asked me, does it make sense to have multiple advisors and managing, maybe some different pieces, and that goes back to exactly what you were just referencing, Keith, is that actually impedes the orchestration from a perspective of, really having to really understanding exactly what is owned inside the portfolio and what the purpose of that specific investment inside the portfolio is. I actually work with a lot of engineers, and so I'm able to actually go really into the minutia of all the spreadsheets and it's super fun, but most of our clients don't want to go that detailed. They want to understand from a much more conceptual of how does this impact me 5 years from now, 10 years from now, 15 years from now, 20 years from now. If I'm coming up on retirement and, my mom lived to 102 years old, guess what? Your plan needs to be built until you're 105. And we need to make sure that the assets actually last throughout that. So what does it take to do that? So there's so many different variables, so many different factors that need to come in there, but orchestrating and pulling together those assets, I can't hammer that enough in regards to trying to get that message home. Please do not leave these old 401k plans out there that you never look at except when you get the statements. You don't redress, and you have 4 to maybe 10, sometimes if the plan's really robust, 20 investment options in. That's not going to help you in orchestrating what you need that money to do from both a short-term and a long-term perspective.
And I think that this concept of diversification oftentimes gets lost, is that this idea of diversification means that we just diversify, like we have all of these different moving pieces, but what we talk about as diversification is kind of all of the people on the boat are rowing in the same direction. Right. And what we find is that when we introduce more and more people to the conversation, then all of a sudden this person has this take and that take. There needs to be a bit of a quarterback. And I will point to something that I love that you brought it up. And I know that there's a lot of folks that feel like they have to have multiple advisors. And I would say that and argue heavily against that, because what's the metrics for success? And 9 times out of the 10, the people goes, well, it's their returns. Well, if I'm a very competitive individual, and I'm guessing there's a lot of other competitive individuals out there, and if our metric for success is return, then that might not be in your best interest. And so you might be actually shooting yourself in the foot if you're saying, I'm going to have these 2 advisors compete for my business. What is your metric for success? And understanding that, because that's orchestrating a whole different band and orchestra. So understanding how they all connect is really important. So absolutely, I think that's awesome. And then, using some of the tools that we have of aggregating all of your accounts and understanding how things are moving and interacting with each other. If you don't know those questions, gosh, this is a good time to start taking a look at what you're doing, because it's times of upheaval, of uncertainty, of change. That change is the best time to take advantage of it. So I would suggest all of our listeners, all of you today that are on, to consider what it means to be working with your advisor. If you already work with us, gosh, I mean, we really appreciate that. And we want to make sure that we're staying engaged with you. So Keith, is there anything else that you want to add there? And what other questions do you think are worth discussing?
I think we've gone through a lot of material here. I think it's the most important things to remember are the fact that there is opportunity and change, and we've got change on almost every level right now. That you always have 3 choices, to buy, sell, or do nothing, and don't kid yourself. Sometimes, oftentimes, doing nothing is the best choice. And the strength of a relationship. When you talk about 2 advisors, I sort of shudder, because isn't it common sense that you would be better off taking the energy of trying to do that and putting it into strengthening your relationship with an advisor that you trust. And so that's something that's important to all of us here at Presidential Wealth Management. We all hold the same standards of putting you first, the client first. And one interesting observation in listening to Alexis, your input, and Taylor, your input over the weeks, is that that plan, that is that sheet music for that orchestra, should actually be built backwards. It should be built. The starting point should be, what do you as a client want?
Correct.
20 years from now, 25 years from now? What do you want? And then build the plan, fill in the pieces, fill in the orchestra, create that piece of music, and then stick to the plan, even through times like this.
Mhm.
So the only thing that we know for certain is that change is inevitable.
Yes.
And today, I think we were able to dive into what is changing and what is the opportunity right now. There's been massive market upheaval. We've seen extreme volatility, 1,000-point days, and it's been to both the upside and the downside. And there are ways forward if you've got cash on the sidelines. If you want to be repositioning your portfolio, what does that look like? Is it a little bit or is it a lot of bit of change? And then finally, how are you orchestrating your portfolio and your financial future in today's extremely uncertain environment? These are all questions that we want to answer for you. So take the time, connect with us, either by way of the offer. You can send us an email directly, or you can go to presidentialwm.com and the contact us page. Alexis, thank you so much for being on today. I know we covered a lot. What is the parting words that you want our audience to walk away with and take to their personal lives as we're talking today?
You know, my main takeaway would be it's going to actually reiterate what has kind of already been said, but I do think it's so important. Change is not necessarily bad. Change does provide opportunity yourself to take advantage. That's how I would look at it.
Alexis, it's been a pleasure. Thank you so much for joining us.
Thank you so much for having me, guys.
Have a great weekend, everybody.
Yes, and don't forget, let's talk about how we can help you achieve your goals and your financial freedom. We are Presidential Wealth Management, and you can reach us at 303.
Presidential Wealth Management securities and investment advisory services are offered through Forta Financial Group, Inc., a registered broker-dealer, member FINRA and SIPC.